Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Reema. Guys, hi. Good morning.
Hi, good morning. Friday morning, and as things stand, we would have our second weekly positive close. Last week, we ended with a gain of 6% on the Nifty, and this week, we're up close to about 0.6%. And the headlines, at least from Donald Trump, are positive.
Well, that's right.
They are positive, and I think let's just take it from the top with where we are at with regards to Qs, right? So U.S. markets continue to do well, and I think that has been the big story. No problems at all with U.S. So it's fresh all-time highs. S&P 0.25% higher, Nasdaq about 0.33% higher, and Nasdaq, it's a 12th straight winning session for the Nasdaq. I think it's the longest stretch we've had, unbroken stretch, since going back all the way to 2009. Now, Trump posted that Israel and Lebanon have agreed to a 10-day ceasefire. Lebanon, of course, was another sticking point out there. Added to this fact, yesterday morning we reported there were reports that, both sides, Iran and U.S. have said that they've agreed to extension of sort of this ceasefire. It's possible that they may extend the ceasefire beyond 2 weeks. It's not set in stone, etc., etc. And maybe that is the reason why. If you look at oil prices, Brent oil prices, last night they went up 3% or so, 3.5%, and we are around $98. If you look at Brent oil futures, they're at about $98, $98.5 or so. So from 94, 95, we're to about 98, 98.5 now. And maybe, markets thinking, well, if they're going to talk for not 2 weeks, but 4 weeks, it basically means that it's going to be status quo, which means the strait will stay closed for that much longer. And energy prices will stay high. Perhaps that is the reason why oil prices took a leg up. Otherwise, there was no real reason, certainly not on the Israel-Lebanon headlines. Trump, of course, on Iran, once again saying it's looking very good that we are going to make a deal. So that's a quote. Netflix stock was down about 9.5% in after hours. Earnings missed expectations. That's a large name. And just to tie in the levels then, lots of single stock news flow, which we will address in just a bit. But yesterday we, came back above 24,300, but we could not sustain it. So supports on the Nifty will now come in at 23,900, levels we put out yesterday as well, and 23,465. It's basically just tracking prior swing highs. The first swing high on the way down is 23,900. The next one is 23,465. Those are the two supports. And of course, on the way up, I'm not sure if we get a retest of 23,465 levels and then you start to move higher, or we never go there and then we start to move up in any case. But the level on the upside is 24,800 or so. Gift Nifty will give you a quick sense of how we are set up, where we start. It's about 17 points lower. It's into a weekend once again. And the news flow in terms of those tweets and Truth Social posts, etc., are expected to be high. So weekends are always tricky. No price discovery, but no stoppage of news flow and headlines. And that's what we've dealt with now for some time. Nigel has walked across to the wall with positioning and the F&O stats. Nigel, take it away.
Well, the message that came in yesterday was there appears to be continued risk appetite beyond the large cap names. And I say that because yesterday was the day when the Nifty and the Nifty Bank went home with a bit of a cut, but you had both the mid cap and the small cap indices that did quite well. In fact, if you look at the advanced decline ratio, not just yesterday, but the last many trading sessions, well, it's been in favor of the number of stocks advancing. And in fact, a few sessions ago, it was even better than 2:1. And I say this in the backdrop that the last few months, on an average, this is NSE data, the advanced decline ratio actually has been favoring the number of stocks declining. So after a while, that's turning around. To be precise, after closure around 5 months, we're seeing that the advanced decline ratio in the month of April is actually in favor of the number of stocks advancing. And that's why your portfolio will be feeling good. So the breadth of the market is seeing a lot of interest. The broader markets are seeing a lot of participation. And that's pretty good, right? That helps you feel like the markets are coming back into its own. The other positive has been the VIX. Remember, a few sessions ago, it almost went to around 30, and that's cooled off. Traders will be looking at a number sub that 15-odd mark. That's the pre-war level. So you'll want the volatility index to cool off yet again. In terms of flows, yesterday there was a bit of a switch. Role reversal is what we saw. The DIs, they turned net sellers. They have been backing up this market. The good news is the FI selling, which just a few sessions ago was 7, 8, 9,000 crores odd. That's turned into a buy number, marginal number, but the bulls will take that. In terms of the futures data, well, there was some unwinding of positions, both on the long as well as the short side. The FI's country remained net short, but not very, very aggressively in absolute contract terms, because now the net short positions on index futures are sub 2 lakh contracts. In percentage terms, it's around 80%. In yesterday's trade, you saw some call writing, though. They wrote more calls than puts in trade yesterday, and we should get a couple of strikes up for you on the screen. The 23,300 call and the 24,000 put, both those two strikes were fairly active. Which brings us to the levels. The recent low of around 23,556, that's the crucial support zone that you're looking at. In terms of the other support level, the 20 DI comes in at. So that's the important support zone. In terms of resistance, the 50 as well as the 200 DM are going to be important. The first level of resistance will be ballpark around this 24,400 odd mark. You'll want to get past this to make a bit of a dash towards that 200 DMA. Finally, the Nifty Bank is going to be in focus. That's going to be the swing factor for today because we got a lot of big earnings that are expected tomorrow. So the Nifty Bank will be the swing factor, particularly in the final hour of trade. And in terms of levels you're looking at, the 50 and the 200 DMA, that's the crucial resistance mark. It's closer around 1,000 points away from current levels, around 57,200 odd. But it seems, irrespective of what happens on the headline index, the broader market participation is good. And that's heartening to see the number of stocks advancing, outweighing the number of stocks that are declining.
Thank you very much for that. The flows picture was quite interesting, right? The FI is buying for the second consecutive day, 382 crore in the cash market, while the DII sold 3,400 crore in the cash market. Tomorrow is going to be a very big day for banking earnings. Two heavyweights, HDFC Bank, ICICI Bank report numbers. Markets react only on Monday. And you also have Yes Bank, which will be reporting numbers tomorrow. But let's get to our guest then. James Knightley, Chief International Economist at ING, is now joining in on the show. James, thank you very much for joining in. We seem to be on a path to de-escalation. Global markets seem to be celebrating. The Indian markets are also up 9% in the month of April, while the S&P and Nasdaq are raking in new highs. But the warning that's coming in from global leaders seem to be that we're underestimating the fallout from the Iran war. So the Qatar finance minister said what we're seeing is the tip of the iceberg. A full-fledged impact is coming in 1 to 2 months. What is your own assessment that even if the war comes to an end, where crude prices will be and what the impact will be on global economies?
Yeah, I think that's a really important point. We are a little bit nervous that the market euphoria that we've been seeing is vulnerable to a reality check in that we still don't know what the real infrastructure damage is within the Gulf region. That could, even if we get back to 100% flows, the infrastructure may not be able to deliver what we had previously been receiving. And also, of course, we've still got to get a deal. We've been here before. There's been optimism before, only for the talks to fail. And we've got to be very realistic that this is not a foregone conclusion. So, yeah, I certainly agree with some of the governments in the Middle East that there is a lot of risk still out there. And even if we do get a deal which starts to unlock the flow through the Straits of Hormuz, we've got to remember that so many countries have actually got to replenish inventory, their energy stocks, in addition to meeting the current level of demand. And that excess demand, if you like, that we're going to be faced with in coming months is going to keep energy prices elevated as well. So that is not great news for corporates. It's not great news, certainly, for households either. There's still going to be quite a lot of economic pain. And we think that's going to be, upward pressure on inflation through the next 3 months and also downward pressure on economic growth. What's
the level of crude that you're anticipating? Because you said that, there will be demand that has to be met and plus stock has to be replenished by various countries. So that's going to keep demand elevated and prices elevated.
Very much so. So even if we get a deal very soon, we're assuming something like we get back to about 40% of the normal flow through the Straits by the end of this month, and we get back to 30, sort of 70% gradually through the summer. So by that point, by say second half, we should, in theory, be back to perhaps 80, 90% of the typical flow. But even in that environment, as I say, with the replenishing of inventory within so many countries around the world, we would imagine we're going to be through sort of at $90 to $100 a barrel through most of the summer, through third quarter, and we may still be in the high 80s towards the very end of this year. So that still is pretty painful stuff.
James, hi, good morning. So let's assume oil stays high, right, in the 90s handle. Could the outcomes for US equity markets and markets here in Asia be very different? So when you wake up and you look at US making a new high, even though oil's jumped another 3.5%, and to extrapolate what US equities do to Asia, I mean, is that the right way, or you think, the outcomes are very different for Asia and US?
I think that's spot on. I think there is a big disconnect. We've got to remember the US is energy self-sufficient. It produces more energy than it consumes. It's a net energy exporter. The US is far, far more insulated from the economic fallout than any country in Asia and any country in Europe. So it's actually going to be much more resilient. There is actually possibly, an investment boom coming in the US oil industry as increasing numbers of Asian and European countries look to diversify their purchases away from the Gulf and go and look at more at the US. So they're a winner from that front. But also the supply shock for America is much, much narrower than it is for Asia and for Europe, because of course in the US it's just motor fuel, it's just aviation fuel. Natural gas prices have actually fallen, so my electricity bill is actually probably going to be dropping. Whereas in Europe and Asia, where natural gas prices have been jumping, there is the very real risk that natural gas on its own plus electricity bills are going to be going up. So there's a much greater squeeze coming potentially for both households and consumers in Europe and in Asia than the US. So I think we've got to factor that into our thinking when in investment allocations, that the US is much more insulated from the negative economic headwinds from all of this.
Europe, I think, has about 6 weeks of jet fuel left. That was a statement that they made yesterday. So we hope that the crisis ends soon, because the ramifications and the implications are going to be very severe and dire. So US is fairly insulated, James. Which economies are at risk the most? Have you cut down your GDP growth forecast for which countries and by how much? Where does it stand now?
Yeah, we've even cut growth in the US as well. So as I say, the US is insulated but not immune from all of this, because, $4.50 a gallon for gasoline here in the United States is pretty painful. And already we've got a household sector that's already feeling a bit of a squeeze. Real household disposable incomes are not rising. So that squeeze on spending power, we think, is a headwind for growth. But look, if we look at Europe as well and look at Asia, I think it's pretty broad spread. Look at countries which are heavily energy importing. The relief is not going to come immediately, and it may be quite a painful story. So look at Japan, look at Korea, look at those sorts of countries, heavy energy importers, Taiwan as well. But in Europe, again, it's pretty broad-based. So we are just much more nervous about the growth outlook pretty broadly in Europe and Asia relative to the United States.
And in Asia, do you want to tell us your India's forecast? Do you have one?
We don't actually cover India right now. We're still waiting for that. But I think in general, we would be looking for the Indian economy to be impacted as well, just given the natural energy import usage as well.
James, great conversation. Thank you very much for joining in. That's the ING chief economist, expecting crude prices to remain at $90 to $100 per barrel, even if a deal comes through very soon. Europe and Asia are going to be, he's nervous about the economic impact on Europe and Asia on the back of elevated crude prices. Let's tell our viewers the interactions that we've lined up on the show today. So first up, 8:30, we get a conversation with the management of Wipro on the back of the Q4 earnings and buyback. 9 a.m., the management of Nuvoco Vistas will talk about demand trends and the outlook going ahead. 9:20, Sanjeev Prasad of Kotak Institutional Equities will be a market master for the day. 9:30, the management of BEML joins in following the recent order wins and outlook ahead. Following that, the management of Keystone Realtors will be with us at 9:40. 9:50, we'll be joined by IIFL's Ranjit Sirumala to put the focus on the chemical space in our QSQT segment. And following that, end of the show in our special segment, Indianomics, Lata speaks to IMF's Asia Pacific Director on the fund's outlook for India and Asia.
Well, time to slip into a short break, but we've got plenty of stocks that we're going to be tracking for you in our special Top 10 segment. The list comes up for you on the screen. Angel One, VST Industries, Kolte Patil, Vadi Renewable Technologies, Vatek, Vabag, and RVNL. All of them will be reacting to positive news flow, while Wipro, HDFC Life, Sammaan Capital, and Axis Bank will be reacting to negative news flow. Take that break, come back. We get into further detail on all of these names.
Welcome back. Let's talk about stocks then. Our research team is standing by with CNBC-TV18's list of top stocks for the day. Hi guys, good morning. But let me begin with Wipro. That's the big one to watch. And as an indicator, Wipro ADR closed down nearly 5%, 4.85%, at a time when the Infosys ADR was up 0.5%, and largely the software stocks in the US were also higher in trade. Now, the reason is the Q4 was a miss on the top line. The company's revenue growth came in at just 0.2%, lower than consensus expectations. And this growth has also come in courtesy and acquisition. If you look at the organic growth, the company doesn't spell it out, doesn't quantify it, but the organic growth would have been negative. FY26 now marks the third consecutive year when the company's growth has been negative. They've ended FY26 with a degrowth of 1.6%, which follows a 2.3% decline in the top line in FY25 and 4.4% in FY24. The Q1 FY27 guidance, though in line with expectation, is also underwhelming. -2 to 0%, which means your base case is that the company still degrows in Q1 FY27. The reason is client-specific issues in Americas too, and though there is a positive contribution from the two large deal wins. Margins for the company came in on expected lines at 17.3%, but looking ahead, Q1, margins are likely to face headwinds because of the wage hike impact and again, the integration-related costs of the large deals. So Motilal Oswal expects a further downtake in Q1 margins. The good part is there is a buyback. The buyback has been 15,000 crore rupees, the company's largest buyback, the first one in 3 years at a price of 250 rupees. Promoters, though, will be participating in the buyback. So that's Wipro for you. To wrap it up, ADR was down 4.85%. And you can catch the management at 8:30 speaking to CNBC TV18 on their Q4 numbers and the outlook.
Okay, all right, that's about Wipro, but let's hop across to Divyani. She's joining to tell us about Angel One's numbers. Morning, Divyani.
A good set coming in from Angel One. Revenue came in at 1,460 crores, up 9% quarter on quarter, driven by strong growth in the trading activity. Employee costs dipped roughly around 11%, but that was aided by some cost reversals by the company. Other expenses was up 20% quarter on quarter. That included IPL promotion costs of 11.5 crores and certain reimbursements to customers worth roughly around 19.2 crores. Adjusted for this one-off, EBITDA would have come in at 498 crores versus 404 crores that we saw in quarter 3, up 23% on a quarter-on-quarter perspective, with a margin expansion of roughly around 400 basis points. PAT came in at 320 crores, up 19% on a sequential basis. And the company is making 300 crores worth of strategic investments in both Angel One Wealth and Angel FinCap, looking to diversify beyond traditional broking. So based on the strong operational performance, we're going with the green on Angel One and trade today.
All right, Devani, thanks very much for that. Well, Vivek is now here with more stocks with news flow. Vivek, take it away.
Well, good morning. First on the list is Vadi Renewable Technology. It's the EPC arm of the Vadi Group. A good set of numbers. Execution is quite strong. Revenues higher by almost 2.3 times on a year-on-year basis. EBITDA up by 63%. However, much higher EPC contract cost this time around 871 crore versus just around 335 crore. Has gone ahead and dented the margins quite significantly, both on a year-on-year as well as on a quarter-on-quarter basis. Margins at 18.8% versus 26.5%. Profitability higher by 67%. This on the back of the higher base. Order book quite strong at 2.83 gigawatt peak, and the bidding pipeline too quite strong. The management says bidding pipeline is over 36 gigawatt peak. Now, the other stock, and it's an important clarification that has come in from Vatek Wabag. Remember, yesterday we had told you about a story where we had said that the company is the lowest bidder in two separate projects, one project in Saudi Arabia and the second project in Kuwait. So Vatek Wabag has given a clarification both to the exchanges as well to CNBC-TV18. As far as the order one in Saudi Arabia is concerned, the company has said that we do participate in various tenders in water as well as wastewater treatment projects in the kingdom, which is Saudi Arabia, and they are in various stages of evaluation. They say that once they receive a letter of award, the same will be duly intimated to the stock exchanges. As far as the order in Kuwait is concerned, they have confirmed the fact that they, along with another JV partner, have emerged as the L1, and here too, they are awaiting a letter of award from the exchanges. And keep an eye out on RVNL as well. The company has emerged as the lowest bidder in an East Coast Railway order. This is for EPC works. Time period of the execution is 3 years. The order size is quite significant at 968 crores. Remember, the company has an order book of over 85,000 crore rupees.
All right, Vivek, thank you very much for that. Well, VST Industries and Kolte Patil are the next two in focus, and Sonal is here with those. Sonal, morning.
Good morning, Prashant. Let me start with VST Industries. Reported strong set of numbers. There was pre-buying ahead of tax hikes and price hikes, which boosted numbers for the company. Cigarette volume growth came in at 8.6%, and cigarette revenues were up 30% on a YOY basis. Additional depreciation of 48 crore was recognized by the company. So overall revenue growth of 31%. EBITDA is up 200% for the company, with a margin expansion of almost 2,000 basis points. The profits also were up 120%, despite the fact that there was higher depreciation this time at 63 crore rupees. For Kolte Patil, Q4 business update was good. Their sales were up 13% on a YOY basis. Quarterly collections were up 18% on a YOY basis. However, on an FY26 basis, their sales value was down 7%, and sales volumes also lower by 13%.
Okay, all right. Thanks a lot for that, Sonal. Well, let's hop across to Yash. He's joining to tell us about HDFC Life. Yash, morning.
Morning, Nigel. So just like ICICI Prudential Life Insurance, the top line or the total premium collection remained weak. But unlike ICICI Prudential Life Insurance, there was no positive surprise which came as far as the value of the business or the margin performance for HDFC Life is concerned. The new business premium, that grew just by about 5% on a year-on-year basis. Total AP, that grew by just about 1%. Retail AP growing at just about 0.37%. This was about the weak top line, but no positive surprise as far as value is concerned. VNB contracted or fell by about 9% on a year-on-year basis. The margins, they came in at 24% versus 26.5%, a fall of about 2.5% in margins for HDFC Life. All these numbers from NBP to total AP, retail AP, VNB and margins are in line with CNBC TV18 poll. There's another development which has happened in HDFC Life. The companies informed the exchanges that it has, HDFC Bank will be participating in the preferential issue of HDFC Life. They would be infusing about 1,000 crore rupees in HDFC Life through this preferential issue. But the sole purpose is to shore up or to increase solvency, and the company's solvency will go up by 900 basis points with the infusion of this 1,000 crore coming from the parent bank, that is HDFC Bank.
All right. Thanks very much for that, Yash. Let's bring in Vivek back on with details on Axis Bank and Sammaan Capital. Vivek, take it away.
Well, first we'll go and see the news flow as far as Sammaan Capital is concerned, a hygiene development here. NSE has gone ahead and decided to remove the stock from the F&O segment, and the current April, May and June contracts will run till expiry. No fresh contracts will start from July 1. Axis Bank, the company has given an update to the exchanges that along with the results, they will also be looking at a proposal to consider either an equity or a debt fundraise. This is despite the fact that the company has a 16.55% CRAR ratio. It will be important to see whether this particular fundraise is mainly going to be used for growth capital. However, any near-term equity dilution could wane as far as the stock price performance is concerned.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are Angel One, VST Industries, Kolte Patil, Vari Renewable, VA Tech Babag, RVNL. Stocks with negative news flow are Wipro, HDFC Life Insurance, Sammaan Capital and Axis Bank. From equities to commodities, Manisha is now joining in for a complete roundup.
Well, thank you for that. I'll start with the crude oil prices, which are headed for a second weekly decline. There are positive statements coming in from U.S. in sense of good relationship with Iran, and the U.S. announcing a 10-day ceasefire between Israel and Lebanon also has done wonders. What the markets are still worried about, though, is that the Strait of Hormuz is completely shut due to a dual blockade by U.S. and Iran, and that is keeping the prices very close to $100 a barrel. What we also have seen gaining is the metal prices. So gold and silver are headed for a fourth weekly gain. You have copper prices, which are 2.5-month highs, zinc at a 2-month high, aluminum trading at a 4-year high, and good gains coming in for the ferrous metals like steel and iron ore. Both of these prices trading at a 2-week highs as well. The firm seasonal demand from China and restocking by end users are all very supportive factors for metals.
Absolutely. Thanks very much, Manisha, for that. We'll take a quick commercial break here. We're going to come back with the management of Wipro. Rima got you the numbers. As promised, the conversation on the numbers in just a bit.
Welcome back. Asia is on the back foot today, but it's had a good run from the start of the week. You've got the Japanese index, Nikkei, down nearly 1%. Hang Seng also lower 1%, 0.5% lower on the Taiwanese markets and on the Korean markets. Remember, while the headlines are positive from the Asian markets, markets across in Asia have rallied hard. For instance, Kospi from the start of the month is up 22%. Nikkei is up 15% from the beginning of this month. The Taiwanese markets also up nearly about 16%. So a lot of the good news perhaps is already in the price, and there is some consolidation taking place. This week itself, many of the Asian markets have rallied between 3, 4, 5%. So some consolidation taking place, and that's perhaps what's getting reflected in the GIFT Nifty as well. For the GIFT Nifty, it's suggesting a slightly lower start. Yesterday, we came off significantly from the highs of the day. In fact, if you pull up that intraday chart, in the morning itself, markets had opened up at higher levels, went on to hit levels of 24,400. And after that, some profit booking had emerged, and we ultimately ended with a minor cut and around the 24,200 mark. It's a light day in terms of earnings. Mastek is the one to watch today, which will report numbers. Many reactions. We spoke about HDFC Life, Wipro, Angel, Vari. But tomorrow is going to be a big day in terms of earnings. HDFC Bank and ICICI Bank will be reporting numbers. We'll talk about Wipro in greater detail. The management will just be joining in. So Wipro reported a slightly muted quarter. Revenues missed the mark. It was just up close to about 0.2%. And the problem for Wipro is that growth has been absent. It's been 3 consecutive years when Wipro's top line has not grown. And this is despite acquisitions boosting the company's growth. The company does not detail out what the organic revenue growth is. But if you look at just Q4, for instance, while the revenue growth was about 0.2%, UBS says 1.5% came in from the acquisition, which means if you strip that out, you're still looking at an organic degrowth of 1.5%. The company has said that there are client-specific issues, etc., which have impacted them in the conference call. But, it's a bit disappointing. And, we can perhaps see that today. In fact, it's a great time then to get the management in of Wipro. I had a chat with the CEO, CFO, and CHRO about the quarter. Let's listen in to what they had to say. And the first question begins with the outlook. Going ahead.
If you look at our quarter 4 results, 3 of the 4 SMUs had sequential growth. In fact, they had sequential growth the last 3 quarters, consecutive quarters, which is Americas 1, Europe, and APMEA. I think the SMU that we see degrowth is A2, which is very specific to a particular client situation, which had an impact in quarter 4. And we also have an impact in quarter 1, and it ends there. Second, also, there are certain deals that, especially the large deal that we have won, it's taking more time than we would normally want it to be. And that's also, delaying the, or rather impacting the growth aspects of it. However, if you remove the BFSI outside of Americas too, both in Europe and APMEA, the BFSI continues to grow for us. In terms of the pipeline, I think BFSI pipeline is strong and robust across the markets. And the only way I could reflect for you, outside of Q1 is how the pipeline looks. It is secular, and it is also robust across markets and across industries. I think our focus this quarter and going forward as well is to close some of these deals and create that momentum. I also want to talk about the deals that you talked about, which is the Olam deal, which is almost $1 billion deal, and it was a very strategic deal for us, and we are excited not just about the revenue commit that we have as part of the deal, but also the opportunities to build capabilities around farm to fork and supply chain based on the kind of distribution that Olam does. And also another acquisition that we just announced, it's part of the vendor consolidation. And we see a lot of these deals which are becoming more and more business outcome led, and we are staying focused on that. And of course, AI becomes integral to these deals as well, Rima.
And this delay in the ramp up of some of the large deals, is it on account of the macro?
It is very client specific, I would say, nothing to do with the geopolitics that's going on or the trade or tariff.
Aparna, can you break up the margins for us in Q4, the impact of the wage hike, M&A integration costs, the benefit due to the INR depreciation?
Our operating margins included all these three factors. If you look at it quarter on quarter, our margins have slightly contracted by about 30 basis points. In Q3, we reported our highest ever margins. So given that we have rolled out wage hikes effective 1st March, and we had 2 months of the acquisition that we had done around Connected Services DTS Harman, we had those two as headwinds, and of course, the rupee depreciation came in as a tailwind, and our operating margin performance for the quarter reflects all those three factors, Rima. On a full year basis, again, we improved our profitability by 15 basis points year on year. So this will be 2 years where we are holding our margins in the narrow band that we have spoken about. As we get into Q1, we do see headwinds of 2 incremental months of the wage hike that we will have to absorb. The revenue environment, given our guidance, you will note is continuing to be weak. So we will have to work through it. There could be some volatility on a quarterly basis, but in the medium term, we will. Our endeavor would be to hold on to the band of margins in the band.
But because now, Aparna, you have the benefit of the rupee depreciation, and can you tell us the exact quantum of the benefit that you had in Q4? Will it help you at least keep your margins above 17% for FY26 because you've got that cushion going for you?
We've got 0.5%, 50 basis points of improvement on account of Forex. See, the dollar rupee is something that's extraneous to, what we can control. What we are focused on is a very robust foreign exchange risk management framework. And to that extent, hopefully if it sustains, then it's certainly a positive as we get into the next year. But we are also investing. We are investing in capabilities through some of the acquisitions that we spoke about. We're investing in deals. We just did 2 announcements in this month. And we are investing in our people. We just rolled out our salary hikes. So we are continuing to invest. And therefore, we will have to improve operationally and not just rely on Forex.
Srini or Aparna, can you all explain the math behind this 15,000 crore buyback? Why did you wait for 3 years to announce one? And what does it leave you in terms of further acquisition or strategic announcements for FY27?
I think we have a very good war chest in terms of the cash that we have on the balance sheet. The buyback that we're doing is after 3 years. We're doing 25% of the paid up capital of the company that is allowed as per the statute. We are maximizing that. It's being done after 3 years, so we believe that we must do a large one. It's going to be one of our largest buybacks that we have announced. This is just execution of returning the excess cash on the balance sheet, ensuring that we have enough for our ambitions around the newly formed unit of Wipro Intelligence Platform. We continue to invest through our Wipro Ventures. We continue to do M&A. And given the leverage we have on our balance sheet, we have a very good war chest.
Saurabh, you hired 7,500 freshers last year. What is the guidance for FY27 in terms of fresher addition, lateral addition? Can you give us an indication of that?
So, Rima, yeah, we hired 7,500. We are not giving a guidance for FY27. Very, very demand specific, and demand looks up, we'll plan that. Today we have enough headspace, both from lower attrition, space to improve our utilization. The supply side is taken care. So the demand for hiring will be very, very demand specific, I would say. Not giving a yearly outlook right now. Very volatile environment.
Okay, one final question, and I'm going to put you all on the spot, but do you think FY27 is going to be a growth year for Wipro? Because the last three have not been. Srini? Yes, no?
It's a very good question. As you know, we don't guide for the year. I think what is important for you to note is, one is our pipeline today. It's very robust, Rima, and it is very secular, like I said, across the markets and across the countries. And second is, like Aparna said, it's very competitive. Winning deals are very competitive, but we are going aggressive. At the same time, if you look at just this quarter, this month, we had two deals that we have actually announced. One is the Olam, and other one is a very specific vendor consolidation opportunity that we got. So with that in the context, if we execute to this pipeline that we have, it should look much better. Rima. That's how I can end the conversation with you now.
That's the word coming in from the Wipro management. We will slip into a very short break. We'll come back and talk about more stocks. Motilal Oswal, Siddharth Khemka joins in on the other side.
Welcome back. There were plenty of big movers in yesterday's trading session. Hormuz joins us to run us through that list and some of them that were backed by big delivery. Morning, Hormuz.
Morning, Nigel. And there were a couple of underperformers in yesterday's trading session, two of them being Astral and Supreme Industries. Both of them saw losses of close to 5% in yesterday's trade. And for Supreme Industries, the most active option yesterday was on the 3800 call option, which was down around 54% on the FNO side. The premiums were down. Astral too, the 1500 put saw very heavy activity. The premiums almost doubled in yesterday's trading session. Now, even on the volumes on the trading front, the Astral had around 23 lakh shares that were traded. The 20-day average is only 7 lakh shares. Supreme Industries also had 6 lakh shares traded. The volumes, the 20-day average was around 2.7 lakh shares. And even for on the delivery front as well, 27% of Astral shares were marked for delivery and 44% of Supreme Industries shares were marked for delivery, both of them higher than their 20-day average. Now, for GMDC, the stock was up 20% in yesterday's trade. The biggest single-day gain since April of 23. The third straight day of gains is gained in 5 out of the last 6 trading sessions as well. And it was significant on the volumes front as well, because the Thursday's volumes were the highest since September of 2025. Over 5 crore shares were traded. The 20-day average of 45 lakh shares. 15% of those were marked for delivery. So that comes up to around 78 lakh shares that were marked for delivery. The 20-day average is around 10 lakh shares. And the stock ended at record highs yesterday and also turned out to be the fourth most traded stock on the Nifty 500. And a couple of outperformers yesterday from the mid-cap IT basket, First Source Solutions and Sonata Software, both of them seeing double-digit gains in yesterday's trading session. The volumes too were higher. It was the best day for Sonata since August of 25. For First Source, it was the best since August of 24. Volumes for Sonata were also the highest since August of 25. For First Source, the volumes were highest since August of 2009. Now for Sonata, there were 2 crore shares that were traded. First Source had 7 crore shares traded, both of them significantly higher than the 20-day average. And on the delivery front as well, 6% shares were marked for delivery on both. For Sonata, there were 4x of its 20-day average, and for First Source, there were 10x of its 20-day average.
Okay, all right. Thanks a lot for that, Hormuz. We'll do a little bit more of a deep dive on GMDC and take some data points of what Hormuz has given us. Massive volumes and massive delivery as well in comparison to its averages. Let's welcome Sid Khemka onto the show. Hi, Sid. Morning. Good to see you. Let's talk about Wipro. Rima just told us the numbers not as good, as what were expected, or a little bit weaker. What's your view on the stock at around $210?
Good morning, Nigel. Glad to be on the show. So I think few key points here on Wipro. Soft quarter. The biggest disappointment was on the Q1 guidance. I think that is below what we were expecting. And thirdly, the margins that are likely to remain flattish to a bit subdued in the near term. I think all these points to compared to some of the other IT players in this volatile environment managing to report slightly better numbers. So we remain neutral on Wipro, and we would wait for things to improve in terms of business delivery. I think the key here is that the near-term headwinds from the ramp-up delays, the top client business decline, and the vertical weakness that would weigh on the stock price. The only, I think, positive that can support the stock price is the huge buyback that the company has announced, which may limit the downside. But clearly, it's a clear avoid in the current situation.
Siddharth, hi, morning. So Motilal Oswal also met the management of Vedant Fashion, the owner of Manyavar ethnic wear. Many stores even here in Mumbai. Now the stock has been a rank underperformer, 45% lower in the last 1 year. Can you give us the key takeaways from your interaction with the management of Vedant Fashion? And is there enough meat for the stock to play catch up and do well from here?
Good morning, Rima. Yes, so we do keep meeting some of these managements to understand what is happening on ground. And while the valuations are turning attractive, but the key challenge remains the underperformance in terms of business. There is a prolonged slowdown in the retail segment, and that is largely due to the macro factors. For example, the IT company slowdown, weak discretionary demand in the mid-premium segment, and higher competition in the organized space. A lot of other players have got into this ethnic wear segment, especially the large nationalized players, including the likes of Raymond, some of the other players, and that is increasing the competition. So what we are seeing is that while the company is targeting an 8% same-store sales growth on a steady-state basis, but the same is yet not converting into the numbers. And the company is focusing on improving the quality of its retail network. But what we are building in a modest 5 to 6% revenue, EBITDA and EPS CAGR, which is dismal for the valuation. So even after a 45% correction, we believe that the business growth is still weak to turn positive. So we retain our neutral rating with a target price of 420, which is around the current market price.
Okay, all right. Sid, do you have any view on Sammaan Capital? It'll be moving out of the F&O list. Mr. Banga, when he joined in, he was very, very optimistic that things in the next 2-3 years are going to look drastically different. And, if he could achieve that, then things could look up for the company. But what's your view?
Nigel, unfortunately, we don't have coverage or view on Sammaan Capital.
Okay, all right. Let me ask you about GMDC. Yesterday, suddenly these miners moved up. Beats my imagination, because now the company market cap is close to around 23,000 crores. This year is going to be a bit of a washout. But, the street is optimistic that in FY28, looking at a Nuvama estimate, they're talking about 1,200 crores of EBITDA. That would still make the stock trading at close to around, 17, 18 times. And that rare earth unlocking should come only after 3-4 years. Have you heard anything on that front?
So, Nigel, again, another stock we don't cover, but we do have a look at the mining stocks and the sector. So I think there is a lot of excitement with regards to the rare earth minerals unlocking for a lot of mining companies. I think if at all, what could happen is that policy has been rolled out. Some of the mines could be given out in the next 1 or 2 years. And the actual business translation could take 2 to 3 years from now. But I think clearly there is a lot of excitement for not only GMDCs, but the likes of NLC India, NMDC, some of the other mining companies where they stand a chance to diversify their product mix into some of these new rare earth minerals as well. Within this space, what we like, NMDC is something that we are pretty positive upon. A structurally strong demand for iron ore, rising realization and steady volume. That is expected to drive NMDC, on which we have a coverage and a buy rating.
Any thoughts on HDFC Life?
But I think HDFC Life, if you see, numbers were not that great in the sense below estimates, specifically the VNB margins. But what we are also seeing is that the outlook from here remains pretty strong. We have seen that the second half of FY26, HDFC Life witnessed a slowdown, but there is definitely some green shoots with respects to improvement in the agency channel growth, the rising protection contribution, and the improving ULIP margins. So we expect the growth trajectory to improve along with a stable VNB margins, which should drive the profitability going forward. And with the ROEVs, operating ROEVs hovering around 15%, we still rate the stock a buy with a target price of 760.
Okay, got it. One quick word I want to ask you, Sid. I think you said you like NMDC, right? From the mining space.
Yes.
What about this aluminium melt up? You know, even gold saw a correction of 25% from the top when we had that skirmish, in Iran, between Iran as well as the United States. But aluminium, it's been sparkling. And sometimes these things take place, right? A couple of smelters got hit. A market that was already tight has got very, very tight. And now everyone's factoring in a deficit for not 1, but 2 years probably. Because to start these smelters will take some time. What's your view on these names? They've had a good run. Vedanta, Nalco, Hindalco, all of them a good run. But I was looking at Alcoa's numbers overnight. The stock actually was down 4% in post-market. That's because it didn't match up to expectations. And the stock is up 180% in 1 year. What's your preference in aluminium?
So yeah, Nigel, I think we discussed this last time as well. Some of these base industrial metals looks pretty interesting, and in the short term, the supply crunch that is adding to the overall the commodity price rise. And we believe that aluminium and copper, these two base industrial metals, will see a super cycle over the next 2 to 3 years. So what we like, Vedanta, which is a pure, which is, you can say, a commodity conglomerate with plays on both, on all the metals, in the sense that you can play zinc, aluminium and copper, which also comes along with the silver in Vedanta. I think that's the top pick there, followed by Nalco, where we believe that the strong volumes as well as strong volumes in the alumina and the higher aluminium prices that will support margins in the next few quarters. And even after the significant rise in the stock prices, we believe that the near-term outlook remains positive. So clearly, these two stocks are our favorite, Vedanta followed by Nalco in the aluminium space.
Yeah, no, absolutely. Point taken there with regards to what happened. Lots of strength in a variety of names yesterday. Power, if I want to just said, if I would ask you, right? Adani Power, by the way, hit a new all-time high. BHEL spiked starting about 250, 255 yesterday and actually ended about 7-8% higher. Interest started to come. Generally, interest started to come back in this space. I'm not just talking about the pure renewable companies, but I'm talking about independent power producers like Adani, like JSW, even Tata Power, etc. Your views here?
I think this is an interesting space. A lot of development. So electricity demand in India is seeing an upcycle. Peak demand has already crossed 250 gigawatts and is expected to move towards the 380, 400 gigawatts over the next few years. What is also helping the overall power demand structurally over the next few years is the rising manufacturing activity, urbanization, data centers, and we expect the power demand to grow at almost 1.2 times the GDP growth over the next few years. And we see that as the generation capacity expands, the next growth is also shifting towards some of the transmission, distribution, grid modernization. So this entire ecosystem is likely to do well. What we like, yes, power utilities, Tata Power is among our top picks. The company is seeing the fast tracking of the 5.2 gigawatt renewable capacity. Also, the core business is also doing that well. So Tata Power, we have a buy rating with a target price of 455. Some of the other, you can say, energy infra companies, for example, we have JSW Energy. Power grid looks interesting in this environment because of the entire focus on modernization of the power grid. Within the renewables, Wari Energy came out with good numbers. That also looks interesting. And also look at something like a Siemens Energy, Kirloskar Oil Engines to the ancillary of the power sector.
Yeah, no, absolutely. We'll just come back to you, Sid. Let me just get brokerage calls of the day with Sudarshan. He's been passing through what we have. Sudarshan, morning.
Morning, Prashant. So first one is Morgan Stanley has written on consumer names. It believes that in a volatile geopolitical environments with visible inflationary trends, it prefers discretionary and retail stocks where growth is visible for FY27. So it has downgraded Jubilant Food to equal weight and target price has been cut to 486. It sees more risks in Jubilant Food emerging to growth in the near term. For Titan, it maintains overweight call with a target price of 5,102 rupees per share. On Avenue Supermart, overweight call with a target price of 5,188, and on Trend, overweight call with a target price of 4,835 rupees per share. Motilal Oswal has written a note on Dixon Technologies, maintains buy call with a target price of 14,700 rupees per share. It says, considering high memory prices, several smartphone makers have started increasing prices, and this is likely to impact overall volumes of the smartphone markets. But despite the volume impact, it sees positives in Dixon Technologies due to various reasons. First, expectation of government relaxing PN3 approval process. Second, Dixon Vivo JV can be approved very soon. And third, ECMS approval for Dixon display modules can be expected very soon. So these are the basic reasons that Motilal Oswal has given, and these are the reasons why they are positive on the stock.
All right. Thanks very much, Sid, for that. By the way, Dixon, of course, did well. Sid, if you want to talk about Dixon, but I mean, let's just put these intradays up. Keynes was up sharply yesterday. Actually, the entire EMS space. PG Electroplast was higher sharply. That is Keynes, 4,200. PG is the other one. Sirma was up sharply. There was Amber, which went up. Quite sharply as well. So these are all 7-8% kind of moves across the board. Actually, if anything, maybe Dixon lagged a little bit. Sid, any thoughts? What do you like here?
Yeah, I think the entire EMS space, after a bit of lug, is now starting to see some recovery. Valuations, at least for some of them, came down, especially the likes of Dixon, which corrected us a lot, and is now looking interesting with the alignment of the government relaxing the PN3 approval process, thereby hoping that the Dixon Vivo joint venture will be approved soon. Plus, we are also seeing the prices for some of these modules as well as the mobile phones that is seeing some improvement that is supporting the overall sector. And also the benefits of PLI. There is some news chatter that the government may announce the next wave of PLI schemes, as the current PLI schemes are likely to end soon. So overall, we believe that the entire EMS space looks interesting. Sirma is consistently outperforms the industry and continues to do well, which is our top pick. At this price, I think something like a Dixon looks very interesting. What we also believe is that the benefits of backward integration will start kicking in from the second half of FY27 and should support the growth going forward. So I think Sirma is a consistent outperformer that remains the top pick, followed by if someone were to look at a stock at a good valuation, Dixon can be that turnaround play.
Yeah. We'll take a quick break, Sid. Stay with us. A couple of more questions coming your way. We'll come back with the pre-open rates. We'll connect with Mitesh and Srikanth, who joins us this Friday, as always, with what they want you to do with trading ideas. Stay tuned. Welcome back. There's 16 minutes to go, a little over 16 to go for the market open. Mitesh Thakkar is with us, and Srikanth Chauhan from Kotak Securities is with us as well. Gentlemen, good morning. Great to have both of you here. Finally, at another Friday. Mitesh, go first. What's the sense? How are we set up?
Prashant, in the short term, good morning. In the short term, I think my view is still positive. Though we kind of rallied from 22,000 odd levels to about 24,400 yesterday. And while the structure is positive, I think this is still, to me, a bounce back because the longer term charts are still pointing negatively. So the idea should be to use buy on declines as primary trading strategy. The first support is around 24,050, and then a good support or the biggest support is around 23,750, 800. So the idea should be that in case you get closer to about 24,100, longs can be taken with a 70, 80 point kind of a stop loss just below 24,050. And on the upside, 24,400, 300, 400 zone was the level which I gave yesterday. So now 24,400 becomes the pivot. That should be the first target. And above that, 24 even, 750, 800 would be tested.
Got that. So buy at around 24,100 if there is a dip today. And the immediate resistance level will be 24,400, which coincides with yesterday's intraday high. Shrikant, hi, morning. What's the Nifty trade?
Good morning, everyone. So for Nifty, again, the logic is same that it is performing much better than the other indices, and it has crossed its important level at 24,000. Ideal strategy should be to create long position if there is any correction in the market. But as we have seen a solid rally of nearly 2,000 points in last just 5 days, I think here we can expect some stock-specific sort of activity, some more consolidation for the Nifty. In that, if we have to create any specific long position with a trading perspective, then in that case, we like Siemens India, which is around 35.50, 35.75. Most of these power-related stocks, they are doing really well, energy stocks. I think in that Siemens is into clearly a technical breakout. From here, the stock can move towards the levels of 37, 37.50, at least in the near term. In the long run, maybe 4,000 plus sort of levels. But 3700, 3750 should be the next target to watch out for. We can keep a stop loss around 3475 for creating long position. The other stock on which we are bullish is from the metal space, and that is Hindalco. There also we saw technical breakout. After a very long time, the stock has broken its important resistance at 900 confidently. So from here, the stock can move towards the levels of 1,050, 1,060, and we can keep stop loss somewhere close to 940 for the same.
Mitesh, your stock calls?
I have a buy. I mean, in fact, I have all buy calls today. A buy on BEL with a stop at 448 for a target of 468. A buy on Eternal with a stop at 247. Would look for short-term targets of 263 to about 265. Indian Hotels is a buy with a stop at about 641 for targets of 675. And also buy on Cummins. Buy here with a stop at 49.75 for targets of 51.80.
Yeah. By the way, Mitesh, Adani Power has hit a new high, right? I don't know, how's that looking? What's the trade there?
Prashant, disclaimer, I have invested into this stock, so it's a part of my portfolio, so there's vested interest. Adani Power, I think, made a good cup and handle pattern. If you look at the chart starting from January 24, May, June 24, it made a high of around 170, declined all the way to about 90, went back to about 170 in October 25, and declined to about 132. So completed a cup and then a handle. And the breakout above 170 happened this time. So I think the minimum target here should be about 205, 210, which is the depth of the handle. But the logical target should be the depth of the cup, which is about 80 odd points. So starting from 170, it gives you a rough target of around 250. So quite positive on this. Only thing is that it's rallied too much. So if somebody wants to enter afresh, now I think a pullback to about 185, 180 should be the area where people can start looking at buying into this again.
Got that. Just one more name is NetWeb. For the last 2-3 days, has started to recover a little bit. Any thoughts?
Yeah, NetWeb again, Prashant, look at the charts from November, and on multiple occasions, I think about 8 or 9 occasions, the stock has taken support around 10 zones and is now trying to break on the upside. The first target should be close to about 38.60, which we are very close to, about only about 150 points from here. But the logical target should be around 4,400, which was the highest weekly closing which the stock did in October 25. So very positive again on the stock, but around 38.50, but 38.50, 60 zone, you might see some marginal profit booking.
Got that. And out of all these EMS names, PG, Sirma, Amber, Keynes, they were all up 5, 6, 7, 8%. Anything looks good?
So I have not tracked all of them, but Keynes, yesterday came on my radar. I think it's made a good bottoming formation around 3,400, and the first breakout about 4,150, 4,200 is just about happening. I think once it clears these levels, the minimum target which I would look for would be close to about 4860, 49,000 zones on the upside. So very positive there as well.
Okay, got that. More later. Thanks very much, Mitesh and Shrikant, for joining us here. Well, we want to play out some market conversation and opinion, basically. This is Ramesh Damani. We had him yesterday, and he believes the worst is over. He did mention that the market should stay constructive. He said for the next quarter, 6 months. And the worst of the US-Iran war, according to him, is behind. And of course, he's looking to play themes. Defense is a big one for him, but not traditional defense, lighter, more asymmetric, spending towards those areas, drones, etc. So listen to a slice of that conversation.
I think the worst years of the war are behind us now. So that is a good sign. I think the markets will tend to favor some of the things that seem to be blossoming this morning, which is perhaps defense, localized supply chain, infrastructure building. So I think we can look forward to a period of gains in the next quarter or 6 months, as opposed to the very, very sharp volatility that we experienced for the last 3 months there.
And those are the three areas you've sort of been positive for a while. I think our last conversation, you defense on your mind, you had some of the mineral resources, right? And some of the infrastructure companies. These are the three areas, themes that you still like, Mr. Damani?
Yeah, that's pretty much summarized my view. I think critical minerals, plus I think the importance of localizing supply chain, whether it's, basic raw materials. I think no country can now afford to rely on a supply chain extending, say, to the Middle East, or extending to Japan, or extending to China. They need to localize and develop the raw materials themselves. So other than critical minerals, also the basic raw materials, copper, aluminum, things like that. The local producers will play a more important role, I think.
These are themes which kind of emerged because of the changing world order we've seen, and we've seen it turn before our eyes. What the Iran war has shown us, of course, is energy dependence as well. You think that perhaps there aren't that many themes here? I've heard ONGC mentioned by some investors, over the last couple of the stocks pricing oil is about $60, $65. I don't know. Is that something that you've thought about as well as a theme?
I think what the overriding lesson I've learned from the Iranian conflict is, while you're right, energy independence is, quite important, but that has been known since the OPEC crisis of 73. We've always emphasized that India has always been, very prone to shocks from what happens in West Asia. And I think we've worked a good job towards reducing our dependence on fossil fuels. But I think strikes me as most important, Prashant, is the need for asymmetrical warfare. A regional power like Iran has basically held the United States to quagmire by using cheap $4,000, $5,000, $20,000 Shahed drones, where they risk depleting their very costly and very expensive cruise missiles, patriotic missiles in America. So I think the nature of warfare has changed completely. I think planners in Delhi or planners in Washington are taking note of this fact. And I think the Indian Army budget that might be skewed towards a lot of heavy armaments might have to be rethought in terms of lighter, more asymmetrical warfare. Because I think increasingly precision missiles and guided drones will be taken over by across the world. So it will no longer be a matter of who has the best gold-plated military, but who has more emphasis on, lighter, flexible, asymmetrical warfare. So I think the nature of warfare has changed. I think it behooves us to pay attention to those matters.
Yeah. And Mr. Damani, if you would allow me, you've been bullish on names like, BEL has been a long-time favorite, and you own a bunch of others, Garden Reach, for example, and Have you added anything new in that space to kind of bet on what you call asymmetrical warfare, cheaper drones and those things?
Yeah, I have. I think sometimes in the unlisted space, you bet on drone manufacturing companies. There are some companies now in the private sector that are more valuable than, say, companies in the public sector. I have exposure to both. I have sold some of the public sector, booked some profits, I would say, in that. But increasingly, I think it's a theme that will continue to propel the market higher for the next few years. I think whether it's in the missile area, whether it's in the drone area, whether it's in the laser fighting area. So in the private space and in the unlisted space, we have made significant bets in these companies.
Significant bets in these companies. And just to sort of wrap up your earlier view, I mean, you're always invested, right? I mean, you're, of course, looking to invest as well, but largely invested both on the private and the public side as well. As you look ahead, Mr. Damani, this is a more steadier kind of pace we would be on, trajectory we'd be on, or you think it'll be very zigzag? You've of course, you warned us it's going to be pretty volatile when President Trump took over, and it's kind of sort of played out. You think it continues to be a tricky place in that sense, or steadier from here? What's your sense?
I think, except for the last 4 years, when we had a pretty smooth ride post-COVID, the index went up without really too much trouble. Markets have been, the hallmark of all markets I know have been volatility, and I think they will continue. I mean, it will be great to see the index double without too much churn, but that's very, very unlikely to happen. But I think most of us who've been investing in India for the last 30, 40 years very firmly believe is that you have to ride out the volatility. You have to make that your friend, buy on the dips, hold for the long term. I think that tends to have better outcomes and more richer money, because I think people who remain invested and not been, say, blown out by COVID or blown out by the Gulf War, I've seen a lot of the returns evaporate where the market kind of turns around sometimes on a dime. So the best strategy I can tell for the young Indians is to remain invested, remain doing their SIP, remaining doing their direct investing in Indian markets. I think we're in a good place, good time. And the volatility that you went through was blood-churning. I'm not denying that. But we have learned over many 30, 40 years that that's just part of the beast.
Sane advice for many of these new investors who've seen the value of their portfolio get eroded in the last more than 18 months now. Volatility is a part of the game, and the best advice is to stay invested through that for the longer term. Let's get in Mitesh once again back on the show. 9:10 call, Mitesh.
I'll go with the buy on Cummins India.
Cummins India. Nigel, GMDC in focus?
Well, that's right. GMDC was buzzing in yesterday's trading session, and we saw massive volumes on GMDC. And it was backed by massive delivery as well, if you just compare it with the averages. Now, the stock had a big move. I didn't hear any fresh news flow. But the probable reasons why the stock spiked up was that the near-term demand for lignite could increase. Remember, there are disruptions in gas supply, and also there's a big spike up in international coal prices. So this, in turn, could provide an opportunity to see that, the offtake in lignite can actually move up. Remember, for this year, that's FY26, the street is factoring in more or less a flattish number in terms of volumes because of what we saw in the first 9 months. But they're expecting higher volumes to come in from the Bhavnagar mine, and they're expecting the opening of the 3 million ton Lakhpat mine as well. That's what could drive lignite volumes in FY27. So they're optimistic that the next year onwards, you'll see good volume growth. Next up, the power plant. That may revert to profits in FY27. Remember, the 250 megawatt thermal power plant, it got restarted in the past quarter. PLF was around 15% or thereabouts. And the first 9 months, if you look at their power segment contribution, it reported an EBIT loss of close to 38 crores. Remember, this is much higher. Then for the entire FY25, the EBIT loss in the power segment was around 19 crores. Point number 3 is the street is optimistic on this rare earth mineral foray. The contribution, though, in terms of earnings will only come in at best in 2030. So for the time being, there'll be investments, but the rewards will come only in 2030. So that's a distance away. Besides lignite mining, they're also getting into coal mining. And the Baitarni coal mine, which is a 15 million ton block, that could start producing from FY27 onwards. So some kind of diversification towards coal mining is what the street is looking at. Finally, in terms of valuations, it was expensive. continues to remain expensive. So I was just going through Nuvama note, the last one they came out with. The diluted EPS they're talking about is around 28 rupees in FY28. So the stock is still trading around 25 times. It's not cheap at all for a mining stock. And the EBITDA number they're talking about is going to around 1,200 crores odd. But the current market capitalization is around 24,000 crores. So effectively on an EV upon EBITDA as well, it's trading close to around 20 times. Net, the street seems to be excited about prospects going ahead. Valuation's not cheap, but they weren't cheap even at 500-600 rupees. Yesterday it ended at around 750 rupees.
All right, very interesting, Nigel. Thanks very much for that. We've got market open coming up in a couple of seconds, I guess. And we'll have the clock come up in just a bit. 24,165. So it's an insipid kind of a start. At least, as far as the open is concerned, then maybe action picks up. Small cap index is up a third. Mid cap index, I think, is also indicating a slightly higher start compared to the Nifty and the Nifty Bank, which is lower. So it's similar to where we left off yesterday. So what do we have? 70 points lower on the Nifty. The Nifty Bank is down about 1/3%. Mid cap index is flat. No change. Small cap index has got some green. It's up 0.2 or 0.3% or so. Advanced decline is still out of the gates opening. I don't know if you've got a first, if that's changing or there's still some from yesterday. But 2 days now, advanced decline has looked very, very good. Nifty heat map will come up on your screen, gives you a quick sense of where the 50 stocks land, right? Where the word go. ITC, Trent, NTPC are doing well, but more down than up. On the losing end, you've got Wipro, HDFC Life, HCL Tech, Bajaj Finance, Infosys are some of the names which are lower in trade. So, it's not a sharp gash or anything of that sort. It's 40 points, but it's a quieter start, perhaps the better way to put it. Rima.
And the mid-cap index is flat, now back in the green, inched back into the green with an advanced decline ratio, which is still positive. So 1,200 stocks on the green line, 1,400 stocks now on the BSE advancing, for about 650 stocks declining. So at least a start for the mid-caps. In fact, now the Nifty and the sensex are also back in the green. Disappointing numbers from Wipro is dragging the IT pack lower. Wipro is the top Nifty loser with a cut of nearly 3%. And that's the reason why. And along with that, you've got the rest of the IT names under pressure. The Nifty IT index is down nearly 1%. HCL Tech, Tech Mahindra selling off about 3/4 of a percentage point, while Infosys and TCS are down nearly 0.5%. HDFC Life also posts disappointing numbers. Has opened with a gap down, 2.5%, nearly 3% lower now on HDFC Life. Hindalco is weak in trade. That's got a cut of about 1%. In fact, Nalco and Vedanta also under pressure. JSW Steel, Tata Steel, the entire metal complex is opening lower, trending down. Asian Paints, M&M, Tata Consumer are stocks where you can see a red tick. On the way up, ITC trend in higher in trade. NTPC is seeing some buying. Reliance Industries has opened up in the green. ONGC up and about. That's got a gain of about 1/3 of a percentage point. The Nifty and the Sensex are now just moving around between the red and the green line. Absolutely flat. HDFC Bank and ICICI Bank should be on your radar. 1 day to trade before their numbers come out tomorrow.
Well, that's right, Rima. But the result reaction of the morning has to be VST Industries. Cigarette volume growth of around 8.5%. Margins expanding to around 45% from around 20%. Bazooka move, VST Industries, pull up that stock. Massive volumes on that name. That's flying away in today's trading session. Angel One as well. That's up close to around 3%. So clearly the street likes what they've seen. Remember, this is a stock that's corrected a goodish deal as well from the top, but it's moved back in style. Revenue growth of around 9%. Margins rise by close to around 400 basis points. The street likes that. Stock moving up close to 3.5%. RVNL, they have been declared the lowest bidder for a 3-year contract. The order size is close to 970 crores. So that explains why that stock is up and about. KPI Green, they have got an interstate power trading license from CERC. So that stock is well up and about in today's trading session. In fact, the result reactions actually are quite good today. You also have Vare Renewables. This is the smaller one. The EBITDA number is up by close to 64%. The revenue number as well has close to doubled on a year-on-year basis. So for the time being, that stock as well has opened up, gap up in today's trading session. So good start, I think, to trade. From the red, we have moved into the green, and a lot of stocks are flying away. Keeping an eye on BSE Industries, the street believes maybe the cigarette volume growth for the industry will be good, because Godfrey Phillips is now up close to around 6% as we speak. Big move out there.
And ITC is also now up nearly 2%, and ITC is the top Nifty gainer. You can see the rub-off impact of VST. Strong numbers, 15% up on VST, but ITC is up nearly 2%, while Godfrey Phillips has a gain of about 5.5%. Pretty good volumes to begin trade with. Kolte Patil is another one where we got an update on the quarterly performance. Kolte Patil has opened with a gain of about 12%.
Absolutely. I think, it's a good start, all told. I mean, from the initial dip, we've sort of come back up about 14, 15 odd points. I just want to say this once again. If we don't know how long oil stays high, but 98 is high, is quite high. 95 was high as well. All the markets react to incremental change on a day-on-day basis. But, you stay in the 90s handle, and you see US equities at an all-time high, and you wonder, well, if US is at an all-time high and markets here should be at an all-time high as well. I'm not sure if that is a straight-cut linear relationship that you should bet on. US is in a very different place with regards to energy. They produce more energy than they consume, and which is not the case for pretty much the rest of the world. Most of Asia, Europe, and of course, India, most certainly as well. Of course, they get impacted because they pay more of the consumers pay more of the pump, but that's a different story. At a top-down, more macro-ish level, it's not. They're not buying oil at $100, $120 odd dollars, which is what other countries will have to. So that's a short point. Sanjeev Prasad is with us, Managing Director and Co-Head Kotak Institutional Equities. Sanjeev, good morning. Great to have you with us here. Thanks for joining in. So just on that point, Sanjeev, this oil bit and the damage it could do to earnings, etc. If it prolongs a little bit more, some of the damage is already locked in. It shows up in the quarters down the line. But how are you thinking about this now?
Well, it's a negative for sure, given the fact that we import about 85% of our crude oil requirement, and even gas, we import about 50% of our consumption. So obviously, higher oil prices are negative for India. And if you do the math, every dollar per barrel is about $2.2 billion negative impact on the economy straight away. And here we are talking about, crude prices being on average higher about $30 compared to FY 2026. Assuming current oil prices stay, if this conflict prolongs, it is possible that crude prices could unfortunately go up. So obviously, we will see the negative impact of higher oil prices to all our macroeconomic variables, right? The direct impact is pretty straightforward. Our current account balance that will deteriorate pretty significantly. So this year, for example, that is March 27, we are looking at about 2% CAC to GDP compared to 1% for 26. And unfortunately, because of capital flows also being pretty weak, BOP will be under pressure, which means probably some pressure on rupee. And depending on how much the government wants to absorb of higher oil prices and at retail level, that is, instead of passing it on to consumers, accordingly, we'll see negative impact on either the government's fisc or inflation and consumption. So we'll have to wait and see how the government responds. But so far, the government has decided to take the brunt of the hit by cutting excise duty on diesel and gasoline. But I don't know how long the government can also continue to subsidize retail prices of diesel and gasoline. So at some point in time, it will probably get passed on to the consumer. I just hope that this gets over quickly. Otherwise, the damage can be a lot more long-lasting.
Sanjeev, hi, morning. So your market view had changed from neutral to negative to a little more constructive when we last spoke to you after the long period of consolidation and price correction. Now, because of the war, the possibility of elevated crude prices, does that market view change? What do you expect going forward?
It all depends on the duration and magnitude of the conflict, right? If it gets over, as it's hoped for over the next few weeks, we are okay in that case. And you don't see that much damage on the macro as also earnings. But if this prolongs, then it's a different proposition altogether. So the view was more like, I would say, from very negative, which used to be 1 to 2 years back, to more like neutral to minor positive, I would say. But given the war now, we have to recalibrate accordingly. As I said, if it's a short-term conflict, let's say 2 months starting from end of Feb, by April, hopefully it gets over. it's okay, it's manageable. But if it continues, and obviously, things are very different in that case. And apart from the macro challenges, accordingly, you start seeing earning downgrades also coming through. One of the reasons why we turned slightly constructive in September, October of last year was our expectation that earnings would start recovering. So for now, we are still holding on to our 18% growth in net profits of the Nifty 50 index for FY 2027. In fact, numbers have actually gone up a little bit because of higher crude prices and higher metal prices. And given the competition of the index, actually the earnings impact is not that high. I mean, if you just break down the earnings of the Nifty 50, actually 50% is coming from sectors which really don't have much to do with the Indian economy. I'm talking about IT services, pharmaceuticals, even if you take utilities, their earnings are protected. Telecom, their earnings should be largely protected. And of course, metal mining, oil and gas, where if anything, you could probably see some earnings increase. And then about 1/3 of India's earnings, at least the Nifty 50 level, comes from banks and NBFCs, where the immediate impact is not that much. Of course, if the situation prolongs, then you start seeing, maybe worries about credit costs going up and accordingly downwards coming through. So the domestic part of the economy, which is negatively impacted by higher crude prices and derivatives of crude prices, is actually not very large, about 15% or so. So it is manageable short-term conflict, but as if it prolongs, then definitely we'll see earnings downgrades. And even though the market is looking slightly okay now at about 19 times running forward earnings, if you start seeing earning downgrades, then you start more expensive. Right? So I would say, it looks okay at current levels, but it's all a little bit up in the air depending on what happens as far as the conflict is concerned.
So Sanjeev, if the conflict ends April end, which seems to be the way the path of de-escalation right now, then you think we can still do that 18% earnings growth for FY 27? If not, what would be the extent of downgrades?
If the conflict gets over in end of April, Strait of Hormuz reopens, oil and gas supplies start to normalize over the next few months after that, then we are broadly okay. I don't see a big earning downgrade coming in that case. As explained earlier, most of the earnings seems reasonably insulated from whatever the challenging domestic part of the economy is going to face. So short-term conflict manageable, long-term definitely we'll see earning downgrades in autos, most of the consumer-facing sectors, whether it's consumer staples, discretionary, etc. One more challenge in the short term is not just the price of oil and gas and the derivatives of oil and gas. It's also availability of oil and gas, and accordingly the negative impact on something like packaging, for example. We are all worried about higher, let's say, petcoke and coal prices for cement. But if you don't have packaging, how do you sell cement in that case? Same way for consumer staples also. So we have some amount inventory. Most companies will be sitting on 1 to 3 months of inventory, so it's manageable. But over time it just continues. You have all sorts of not just the first order impact, which is higher inventory prices and lower margins accordingly, but also second and third derivative impact, which is slightly tricky to model as of now. But honestly, the impact is non-linear. That's our problem. Short term doesn't matter. If it continues for long, the impact is not more negative. And if the duration is even longer, then the impact is actually, unfortunately, exponential. That's our problem over here.
So 18% earnings growth, valuation and 19 times for India. How would it compare with other emerging markets? Because you also look at it closely, and you've talked about the FI outflows that we've seen from India.
No, that's the whole challenge as far as India is concerned. So if I look at India on an absolute basis, it doesn't look too bad. But as far as investors are concerned, we're looking at India on a relative basis. India doesn't stack up very well. And unfortunately, from India's perspective, we have countries that are showing some insane amount of earning growth. You have Korea, for example. There, the 26 calendar year is supposed to grow 200% by the way. Yeah? And it's market trading at 8.5 times. Obviously, 200% growth is coming because of very high demand for chips and prices of chips going up significantly and so on and so forth. May not be sustainable, but that's what the market is looking at, 8.5 times, 12% growth in earnings. Even in 27, if I look at Korea, It's actually 7p. We're still looking at 20% earning growth in calendar 27 also. If you look at Taiwan as an example, again, country very exposed to the current chip cycle, AI cycle, etc. Trading at about 19 times net profit growth expected about 50%. And then you have the big daddy of all, which is the US. You look at the Nasdaq over there, it's about 27p on December 26 numbers, and the net profit expected to grow at 38%. That is what we are competing with, unfortunately. So, as of now, India's struggle is, if we don't really have any AI-related stories, and that's what real excitement is. And also, there's a lot of excitement around commodities. Metal prices have gone up a lot. So then you're also competing with countries which have a very heavy base as far as commodities concerned. For example, Brazil, trading at 10 times December 26 numbers. The net profit growth is about 40%. I mean, it's a very commodity-heavy market. So that's the trouble for India. If you look at the EM basket, either you're competing with countries which have very high exposure to the AI trade and commodities. And if this continues, that is, the excitement over AI and commodities continue, I mean, India will probably continue to get overlooked. If you look at the last 1.5 years, because of the performance of India, the weight of India itself has come down so much in the MSCI Emerging Market Index. It's down to below 12% now. It used to be almost 20% toward the end of 2024 calendar year. So you are running into a, somewhat, I would say, a risky zone where people start to ignore India, unfortunately. Not something you want to hear. But at 12%, it's neither here nor there from many portfolio managers' perspective. Obviously, it's still a very large country. Growth prospects are tremendous in the medium term. All that is there. But in the short term, you're just competing with countries which are showing tremendous earning growth, for whatever reasons, AI cycle and or commodities.
Sanjeev, when you say, it's interesting the way you put it, it's risky, the way perhaps, is the risk that India is being ignored, or is it risky that India is being ignored? Because both are very different. Right? Because if it is risky that India is being ignored, my question is, wouldn't reflexivity kick in? It's so under-owned now that it automatically there is mean reversion.
No, what I meant was that you run the risk of India continuing to get ignored. I mean, it's already getting ignored, right? If you look at the amount of outflows, as far as FPI outflows are concerned, it's like crazy. I mean, the month of March, you saw $40 billion of outflows. February, you have seen only $4 billion, almost $4 billion. Yeah, so that's a huge drag as far as the economy is concerned, right? So much money going out in a way. So if this continues, and India is obviously very vulnerable to the challenges that you are seeing because of the West Asia war in the form of high crude prices and natural gas as well and so forth.
And Sanjeev, there is no mean reversion here. There is no mean reversion here. There is no reflexivity here. It could continue.
We are not hoping for that, but as long as the AI trade and the commodity trade continues, I think we will probably be on the sidelines only.
Just one quick question. If crude prices remain elevated, you said there are two options. The government bears the cost, which is what we're seeing right now, or it's eventually passed on, which again hurts inflation, spending power, etc. comes down. In the event that the government bears the cost, its spending ability gets constrained. How will that show up, and which sectors could that hurt?
We do have some buffers. If you look at the way the government has gone about tackling this problem, it has created the Economic Stabilization Fund, right, roughly about 1 trillion rupees. Our assumption is you can also get some money from extra money from the RBI compared to whatever the expectation or the numbers in the budget. And also because of higher export duties on petroleum products, you get another 550 billion rupees or so. And if you sort of postpone consumption on some of the capex on some of the items like investment in BSNL, etc., you can save about another 1 trillion rupees or so. So based on our math, what have we done at $85 per barrel, and including this excise duty cut of the 10 rupees per liter of diesel gasoline, that's about roughly 1.65 trillion rupees impact, including higher impact of LPG and fertilizer subsidy. It's roughly 3 trillion rupees. And as of now, broadly between 1 trillion rupees in the Economic Stabilization Fund, roughly 250 billion rupee extra which you can get from the RBI, 550 billion rupees extra from excise duty, high excise duty on exports of diesel, gasoline, ATF, etc. And some, postponement or capex, I think we can still manage. I don't see a big fiscal impact immediately, but as I said, if food prices are higher, then of course the government may not have any option but to pass it on to the consumer, which has its own, either fiscal implications and or inflation implications.
Sanjeev, thank you very much for joining in. Happy Friday to you, and look forward to our next conversation.
My pleasure. Thank you.
Thank you very much for joining in. Let's invite the first corporate on the show, actually second one. We spoke to Wipro as well. BEML is in focus on the back of the recent order win from West Asia to supply heavy earth-moving equipment. Remember, the company's international order book now stands at $107 million as of April 2026. Shantanu Roy, CMD of BEML, is now joining in, and a couple of discussion points with him: supply chain stability, defense and export order inflow, and outlook on the large tender pipeline. Thank you very much, sir, for joining in. Rima here. Let me begin with the second point about the defense and the export order inflow and what we should expect. Now, because of the conflict, have we seen a pickup in the overall order inflows? And your guidance for the full year for FY26, you had spoken about a 20% revenue growth, order book of 20,000 crore as we wrap FY26. Are those two numbers? Have you met these two numbers?
Good morning. Let me talk about the impact of supply chain, impact on supply chain and the order book, order inflow. So the conflict directly does not have any impact on the order book as far as the exports is concerned. The order that we have received from West Asia, it has been going on for quite some time now. I mean, we have been working on it for almost 7 to 8 months. And finally, it has come to us. And it's a game changer for us, I believe, for the heavy earth moving machinery. These are special type of equipment that we'll be supplying, special in the sense that our normal equipment, there have been a lot of modifications, there will be a lot of design modifications, including, enhanced fuel capacity, advanced provisions for armoring, then the ROPS and FOPS, that is a rollover protective structure, and the falling object protective structure cabins that have been specially designed for this. And this project also has a provision of a 12-year annual maintenance contract, which is of course not reflected in the current order book value. It will come to us subsequently, 5 years and 7 years optional. This order also has a provision of 100% repeat order within next 3 years. And the stages that we'll be following in this order is, first is we have to develop, we have to do the design validation, proto development, and then the bulk supply. As far as the supply chain is concerned, fortunately, it did not impact us in a big way, I would say. But yes, one of the reasons was that we have indigenized to a great extent, and our dependence on imports has gone down drastically, especially for the heavy earth moving machinery, for the defense equipment, for the commuter rail. The current order book, since it's aspects, other points, but what I can share with you is that our current order book, if you look at the breakdown or the breakup of the current order book, it is 66% from rail and metro, 23% from defense, 5% from mining construction, and a very healthy 6% from international business. And we have been talking about our aspiration to have at least one rolling stock order from the international market, and that we could achieve in the last financial year after having got the $60 million rolling stock metro order from Africa. As far as FY26-27 is concerned, order book, we are looking at an opportunity size of around 40,000 crore in defense, aerospace, in rail and metro, and in mining and international business. And as I talk to you, there is already a tender for 110 million euro for heavy earth moving machinery, which has been announced in Tunisia. So that is a good omen for us, because we have done a lot of business in Tunisia for their mines, having supplied a lot of mining equipment over the last 20 odd years.
Okay. So
Second is
yeah.
the partnership, the strategic partnership that we entered into Delhi with DMRC. So that is going to hold us in good stead. And out of this 40,000 crore, I expect to have a success rate of around 50%, with rail and metro leading it, followed by defense and followed by mining and international business.
Okay. So we should look at an order inflow of about 20,000 crore for FY27 as well, assuming a 50% success rate. And the opportunity side is 40,000 crore rupees for next year. On international, you crossed that $100 million order book. What's the next milestone that you're targeting?
The next milestone is crossing $200 million order book in the international business, for which we will need to address more orders in heavy earth moving machinery, more orders, more opportunities in the rolling stock, and of course the defense, the platforms, the high mobility vehicle platforms.
Do you think you get there in FY27, given the pipeline, or how long will it take for you to get to $200 million?
We will, since already one tender is out in Tunisia, as I mentioned, and we are aiming for some more projects of large capacities. So we will aim for $200 million order book. That is 100 plus 100 we have currently, and 100 more in FY27. And of course, this order from West Asia, which has come for the heavy earth moving machinery, we will try to execute this entire order this entire order within the current financial year, that is FY26-27, even though our delivery is scheduled to end in May 2027, we'll try to complete that by March 2027.
Okay, all right. Hi, Mr. Roy. Good morning and good to see you in. Nigel on this side. A quick check with regard to the guidance you had given us earlier for FY26. You were talking about 20% revenue growth, margins improving by 150 basis points, and the order book swelling to around, I think, 23,000 crores. On all these three parameters, what's the update? Oopsie daisy. I think that line snapped out there, but we'll wait by. I think we'll reconnect with Mr. Roy on that front. For the time being, sounding very optimistic on the international order book. We'll add another $100 million in the coming year, and that's how they'll scale up. But Mr. Roy is back with us. Mr. Roy, I want to ask you about FY26. Three numbers. You had guided for revenue growth of 20%, margins improving 150 basis points, and the order book swelling to, I think, around 23,000 crores odd. What's the update on all these three numbers?
Very good to see you, Nigel, again.
Always good to see you, sir.
That brings a smile back on my face. These numbers, I think we'll discuss after our audited results are out. And we'll have to wait for another month or so.
Okay, all right. On whatever you deliver then for FY27, how are things looking? And I had a word with regard to these exports. You're talking about scaling it up, but as of now, are exports profitable?
Exports are definitely profitable. If you talk about the margins, I've always maintained in our earlier conversations also that our margins are driven by, number one, the exports, number two, the sustenance, number three, the high-end mining equipment and the commuter rail products. Okay. So these 3-4 are our drivers for the margins, for the bottom line.
And exports guidance as a percentage of the total mix, what will it be? In FY27, sir, since 26, you're in silent period.
Sorry, I didn't get a question.
Exports as a percentage of your revenues in FY27, FY28, what will it scale to?
Exports in 26-27 should be around 6 to 7% of our total top line, and 27, 28, 29, I would like to scale it up to around 10% of the top line.
Right.
That is the aspiration.
Good morning, sir. Prashant here. I just had a quick question. We are out of time, but briefly, if you can tell us, very, very briefly. Yesterday we had Ramesh Damani with us, who's an investor, and he was saying that his biggest lesson from the Iran war was that the pattern of, or he thinks, at least maybe it's a hope or it's a signal, things he's picked up, but it's logical, that the pattern of ordering from defense side for our forces perhaps moves to, lighter stuff. What Iran has shown is asymmetrical warfare, right? I mean, cheaper drones and that kind of thing. Have you seen any, it's too early, of course, but do you believe that's a logical kind of expectation to have? You're a big supplier to defense, but I mean, on the traditional side. Go on, sir.
Hi, Prashant. I missed the first part of your question. There seems to be some challenge with the connectivity.
No, I was just saying.
But yes, I definitely agree with what has been, what is expected, and that is going to be the future of warfare. We all know, we have seen how Russia-Ukraine war has panned out, how this current conflict in the West Asia has panned out, and this is going to be the future, the contactless warfare that we are all seeing. And this is definitely going to be the future.
It's going to be the future. Yeah. So would you look to participate in that future, sir?
We are contemplating. We need to diversify. We are contemplating how we can contribute to that. Currently, our focus is all on non-kinetic type of equipment to support support our defense forces, and it will be a diversification which we will contemplate how to go about it, how to do it.
This 23% order book of yours comes from defense. Of that, it doesn't come, nothing can be attributed to this precision warfare, drones, etc.
The opportunity size that I mentioned, it does not have any of this because it is too soon. Even if we start preparing today, or had we started preparing 6 months back also, it will take at least 3 to 4 years to come to that stage.
Absolutely.
So yes, the current aspiration of order book and the opportunity size that I have spoken about, it all is based on our current strengths, our current capabilities in defense.
Which is high mobility vehicles, military wagons, armored recovery vehicles, bridge systems, etc., right? So, but you, as you said, you are contemplating more diversification.
Then we have trawl, we have self-propelled mine barriers, we have command post vehicles and all, which is basically, we have gone ahead one step from being a platform supplier only to the system supplier. So the MME is a system, the self-propelled mine barrier is a system. So it is organic diversification, I would say, that we have already achieved. And we are further going to consolidate in this sphere.
And we will talk to you again soon. So apologies, we're just running out of time. We've got back-to-back corporates lined up on the back of earnings, but we will keep talking to you. As you said, you are contemplating diversification into more kinetic systems, and the future, as we spoke about, drones and things like that. So it's a conversation we will keep having. Thank you for joining us, Mr. Roy. Appreciate it. The management of Keystone Realtors will be speaking with us on the other side. Stay tuned. Coming up.
Welcome back. Some green on the screen. Breadth of the market continues to remain positive. So that's good tidings then from a bullish perspective. Maruti Suzuki is a stock actually that's moved to the high point of the day. One of the biggest gainers on the Nifty. It started off in the red and then it's picked up pace. So Maruti at the day's high. But let's focus on the realty pack. Keystone Realtors, that's the stock in focus. The company has achieved its FY26 pre-sales guidance of around 4,000 crore rupees. Joining us now is Baman Rustam Irani, the CMD of Keystone Realtors on the show. Hi, Baman. Good morning. Always good to have you on the show. Well, on this sort of a base of around 4,000 crores odd, what kind of a growth are you guiding for? And give us a brief insight in terms of customer behavior. What have you observed in the last few months? The stock market does a thing of its own with regard to share prices, but on ground, is demand as strong?
First of all, thank you, Nigel. And like the earlier speaker mentioned, I think it's always nice to see you guys. First of all, let me tell you, Rustomji is now 30. We're 30 years old as of this year, and now we are in our prime. Our entire teams are primed up to kind of take on the future. And the way we are describing our future is the next is best. We've clocked about 4,022 crores in pre-sales, like you've already mentioned. And Nigel, if you remember, the question that we faced the last time also was the markets are slowing down. Do you think this will continue? We clocked our probable best quarter, about 1,346 crores of pre-sales only in the last quarter. Even our collections have been best in the last quarter, being 800 crores plus. So overall, we are very confident that given the MMR landscape and the kind of projects that we are doing, this will keep us in good stead for the future. Add to that my teams have launched about 10,000 crores worth of projects in the last year. And at the same point of time, have added projects closer to 10,500 crores. So all of this is just a sign of what is going to come in the future. And like I said, we at Rustomji are saying next is best.
All right. So 4,000 crores is what you've achieved in the past year. On this pace, will you be guiding for a 20, 25% or 30% growth?
So I will stop being shy and I will say this, that if we keep this pace of growth, we'll be at 10,000 crores in about 4 years' time. Because that's the kind of growth we've given over the last 3 years. We've always achieved our milestones. We've continually worked towards improving our teams and towards making sure that we achieve every milestone that we have, guided for. So including GDV of projects added, projects launched, and of course the pre-sales, which happens to be a very important precursor to most of the conversations, have been at a growing pace of about 25 to 33%. While the MMR market has grown only 9%, we've shown a steady state growth of 35% plus in the last 3 years, and nothing is pointing to otherwise. As a matter of fact, we believe that we've risen to about 2% of the total market volume by value, and we are probably going to only keep growing this. And given the fact that companies with the ability to kind of deliver on time and give the right product are only growing their portfolios, we look forward to a bright and beautiful future.
Bowman, hi, morning, Prashant here. I was just thinking that you got, if you take the four of us, three of us here in the studio and you on the other side, you got an even split between Bandra and Parel. And you got projects coming up in both locations. You got a large project coming up in Parel. And just a quick, is absorption happening, sales happening pretty quickly, or lots of projects in that area, Bhavan? For example, there's a huge project coming in from Sattva, pretty close. I think it's one of their first projects. Godrej, Sobha is there. Rima is telling me more names. So
you have two buyers in the studio.
Is absorption easy? Is absorption, what's happening? Yeah.
I don't know, Prashant. I've always said this, and I am a true believer that the more developers that go to one particular area actually kind of exemplifies the importance of that area. It brings to fore the fact that there was an area that is going to be growing a lot, right? All the research, all the data points in that direction. And if you look at the kind of infrastructure that is happening in the city and the connectivity, you take Parel and you take Worli, they're going to be hardly about 5 or 7, 10 minutes apart once the bridge gets completed. And you look at the price arbitrage you get. You get a home in Lower Parel at about, or the Parel area, city area at about 45 to 50,000 rupees. Whereas you take a project in Worli and you can get as much as 1.5 lakh rupees, right? So obviously there's a locational advantage to Worli with the sea, but all of those advantages are being noticed even in this area called Sivri. And we are seeing a huge surge of developers coming here. At the same point of time, development taking place out here. And as a matter of fact, it could be the next BKC when we went to the Mada layouts and we kept telling the people that if you buy now, you will more than double your prices. I think we proved ourselves wrong. We more than trebled or in certain places quadrupled the prices that we sold initially from. I think the same will happen with Sivri, and it's definitely a hot location that is important for the future. At the same point of time, our portfolio actually quite honestly extends all the way from Thana, Dombivli, Bazaar, and all the way into South Mumbai as of right now, Parel being where we've already launched the project this quarter. And we look at a bigger surge taking place in the South Mumbai area, but given the infrastructure growth. And I've always said, the government's said, watching pace for this, and it's up to us developers to make the most of it for the citizens of the city and give them a good home where infrastructure is available the most.
Yeah, no, absolutely. And I hope those words come true, that Shivri is the new BKC. Just so, trajectory, you've set the end target, but you've got to live day to day, quarter to quarter, or 6 months, every 6 months, right? And in that sense, it's a graph. Hopefully it's a upward sloping graph. So are we right now in a bit of a funk, or is it steady? I mean, my question, basically, that absorption question right now, longer term is a separate issue, but is it all selling through easily?
So again, the first quarter of the year is always a little slow. The last quarter of the year is always the best. And given the fact that you have a lot of festivals coming up in the second and third quarter, things only start getting better after the first quarter itself. So the first quarter is when you kind of double down and work on your systems and processes, get things done, and work on your launches, which will allow you to sell extremely well in the second, third, and then of course the fourth quarter, where both the year end is something prime that people are actually buying and making their investments at that point in time. If you're asking about the short term, I can tell you the projects this quarter will be a little slow, but at the same point of time, the slew of launches that we've done last year, like I mentioned, 10,000 crores worth of launches, we'll see a lot of buying happening, because as we mentioned, we sell about 30 to 40% of our stock before the plinth comes up, which is roughly 6 months within the launch. So you will see a good buying taking place, and we will be reporting a good quarter.
All right, Bowman, we'll leave it there. Good conversation as always, and maybe we should do a slighter deep dive into that particular area, right? And get your thoughts longer term in terms of, that connector is coming up, from Shivri to Worli, and a lot of infrastructure projects, etc., which perhaps change the landscape, connectivity, distance, time spent on the road, etc., over the next 10, 15 years, maybe shorter, hopefully shorter. Thank you very much once again. Appreciate it. We'll take a quick commercial. Okay, we're going to take a break here. We'll get you the update in terms of the preview with the specialty chemical space. Quarter se quarter tak. Sonal will set it up for us before we go to our analyst. Sonal, take it away.
Thank you so much for that. Well, the chemical sector is seeing early signs of cost pressure with a sharp increase in input as well as finished product prices. But do remember, every chemical company has a different fundamental, right? But during the month of March, this is important because specialty chemicals are closely linked to base petrochemicals such as ethylene, benzene and propylene as well, which in turn track crude oil and natural gas prices. In the near term, some companies could benefit from price hikes, but the broader impact of rising input costs is likely to start reflecting more meaningfully from Q1 FY27 onwards. Q4 FY26 for most companies remain steady because of having some inventory levels, but this could be the calm before cost pressures fully come through. There are already some early disruptions being flagged. Players like Alkyl Amines and Balaji Amines, they have announced force majeure due to ammonia unavailability, highlighting supply-side stress. The agri-input segment also continues to remain uneven. Fertilizer companies in particular are facing margin pressure as input costs rise faster than realizations. But let's take a quick look at some of these companies, how they will be performing in Q4. This is based Bloomberg estimates. SRF is expected to report an EBITDA decline of 5.6%, but profit growth could come in strong at 15.6%. Navin Fluorine will see robust growth, both EBITDA and PAT up 37%. Acutaas Chemicals to see sharp momentum. This has been an outperformer in the chemical space. EBITDA expected to increase by 77%, PAT up 68%. But on the weaker side, some of these commodity chemicals might not do so well. Deepak Nitrite expected to report a 34% drop in EBITDA, 25% decline in PAT. Galaxy Surfactants hasn't been doing well for a while. It is also expected to see pressure with EBITDA down 24%, PAT down by around 15.5%. UPL is expected to see EBITDA declining by 16%, but profit could see a growth here by 13%. On the valuations, the space continues to trade at a wide range. Navin Fluorine and Acutaas Chemicals remain on the higher end at 50 to 58 times basis FY27 earnings. Deepak Nitrite and UPL are closer to the lows at 20s. SRF is at around 40 times and Galaxy Surfactants trade at 17 times. But going ahead, there are two key monitorables for the sector. One is developments in West Asia, given their impact on energy-linked inputs. And the second is management commentary around pricing power, demand and margin outlook as we move into the next quarter. And more importantly, as every company has a different fundamental.
Okay, all right. Thanks a lot for that. Sonal, well, to discuss this, we're now joined by Ranjit Chirumala, the Senior Vice President Research at IIFL. Hi, Ranjit. Good morning. Good to see you. When you heard what Sonal had to say, where should we expect that earnings surprise from the chemicals pack for the past quarter?
If you look at 4Q, there will be few surprises. What we have seen in the month of March is there has been price hikes. So the ones, to give you a few examples, PVC prices has seen a significant spike for the last one quarter, almost 60% up. Over the month of March, we have seen phenol prices, acetone prices spiking. So clearly, this is what we will see. Deepak Nitrite on a sequential basis is likely to deliver a strong performance, and PVC prices should benefit Chemplast Summer. But the caveat here is that we are not sure about the sustainability of these prices. Hence, one should not extrapolate these earnings into the 1Q.
And what could be the extent of stress in Q1? Are we looking at EPS downgrades? And if yes, could you give us a sense?
Yeah, if you look at the key parameters that the sector's earnings determine, if you look at crude oil, we have seen an inflation in the crude oil that should translate into a significant input cost inflation. Rupee has depreciated. While this may benefit exporters, but the shipping disruption that we have seen will definitely have some impact on the sales front. So given these factors, the risk to FY27 has clearly emerged. While we believe that is not going to uniform for the entire sector, hence we are waiting for the management commentary. Given the linkage to the natural gas chemicals and the crude oil chemicals, we will see a very difference across all the chemicals companies. To that extent, we are closely watching the 4Q earnings and the management commentary, and then the earnings will be calibrated accordingly.
Okay. Sonal was also talking to us about how some companies like Alkylamines, Balaji Amines have all declared force majeure. How serious is the ammonia shortage and how is it going to get reflected?
While I don't track actively these companies, but yes, there is a pressure. So if you look at India, we are majorly dependent on ammonia and sulfur. Ammonia is a clearly natural gas derivative. So to that extent, India is predominantly dependent on the imports, and availability of ammonia is getting incrementally challenged. But there are steps that the companies have taken. We are working with the US, and there are expectations that we will enter into an energy deal there. So barring this near-term disruptions, expectations are that we should be able to tide over this crisis. But till the time that ammonia will remain a bit of a challenge, the fertilizer companies and largely the complex and the amine companies are exposed to this supply disruption.
Okay. And finally, you want to tell us how the valuations stack up? Sonal, give us the picture right now, but how would it compare with historical averages, the mean, and which stocks do you like, Ranjit?
If you look at the sector has been in a sideways for the last 3 years. We have seen a significant destocking and deflationary cycle. There are early signs if the supply disruption kind of stays a bit longer, we could actually enter into a restocking cycle. And there is a bit of a pricing inflation that we have already seen. So the adversities may most likely may trigger the upcycle, but it's too early to comment on that. And to that extent, we'll have to wait and see how this pans out. As far as the valuation is concerned, there has been a moderation. The sector has not done well over the last 3 years. Yes, there have been a few exceptions to this larger trend, but overall, the sector remains a bit in a sideways, and we are looking for that upcycle.
Thank you.
On the preference front, if you look at, we are continue to prefer the long-term outsourcing stories like SRF and Navin Fluorine, and the import substitution stories like Deepak Fertilizer and Deepak Nitrite.
Got that. Thank you, Ranjit, for sharing your insights. We will slip into a break. On the other side, Manisha Gupta will join in to talk commodities. Welcome back. Let's talk commodities now. Manisha Gupta, as always, joins in. Manisha?
Thank you so much for that. And the best sector performance that we have seen come in for this week is clearly coming in from metals. Expectations of a more permanent ceasefire between US and Iran is what the street is working on. And then you also have firm demand signals coming in from China. The Chinese data, the Chinese demand, the Chinese inventories have all been very bullish for the metal prices there. I'll start with gold and silver, which are headed for a fourth weekly gain, by the way. And from the kind of sell-off that we saw in the month of March, from there's a good amount of buying for these precious metals. So when you look at gold, there is a 17% of a jump up from its March lows. And silver, by the way, is back by nearly 30% from its March lows. But precious metals is just one part of this. When you look at base metal prices, there are stronger gains coming in there. Copper, for example, is trading at a 2.5-month highs right now. And we have seen copper prices in the international markets do quite well. Also, when you look at Chinese imports data for the month of March in sense of copper, ore and concentrate, well, that is gained up by 6.5% on an year-on-year basis. Apart from copper, what is also doing well is zinc prices, trading at around 2-month highs onto this one, above $3,400 a ton on LME. The Shanghai inventories have declined 1.7% in last 1 week itself, and the ongoing mine closures and operational disruptions have also been quite supportive for the zinc prices there. And then you have aluminum, which clearly is an outperformer on a week-on-week, on a month-on-month basis as well. So prices here for LME also are trading above $36.50 a ton. You are looking at a Wood Mackenzie report which says that 4 million tons of a deficit globally in 2026 is what they're working with right now. So you have various names, for example, Emirates Global Aluminum, Alba, Qatar Aluminum. They have cut production. This is within the Middle East. But outside of Middle East as well, it is Mozal Aluminum Smelter in Mozambique, which also has been placed on care and maintenance. So there are supply concerns coming in from various areas, including Indonesia as well, which is facing some power problems therein. So LME stocks are under 4 lakh tons, and you also are looking at Shanghai stocks lower. The LME warehouses deliverable stocks have seen a 70% of a decline coming in, and it stands just at around 1864 tons therein. So CME, LME and Shanghai exchanges have seen aluminum inventories continue to decline. That's about base metal prices. Ferrous metals also have seen gains come in. So when you look at iron ore, 1 week highs on that, the stronger than expected China economic data has been supportive. And then you have steel rebar futures also trading at a 2-week highs. This is after China Steel Corporate says that they're looking to raise domestic prices for a 5th straight month onto this one. There is also a report from World Steel Association suggesting increase in global demand growth from nearly 1.72 billion tons in this year to 1.762 billion tons in the next year. So you're looking at stronger demand, weaker US dollar index, stronger buying, money rotating here, decline in inventories, all of that as very supportive factors. This is what we've done in the last 1 week itself. Gold is just about 0.5% higher. Silver outperforming with 3% of gains. And 2 to 4% of gains is what we're looking at across base metal prices. And as you can see, the outperformance clearly comes in from aluminum. That one is trading at a 4-year highs, 6% higher in matter of just a week itself.
All right, Manisha, thank you very much for that. We'll take a quick commercial break here. On the other side, our special segment is the economy. Lata will be speaking with IMF's Asia Pacific Director on the fund's outlook for India in Asia post the West Asia war. Stay tuned, coming up.